most people are used to getting paid for being smart, or they're used to getting paid for the time. They're not used to getting paid for both. And so what happens is that most of the wholesale guys, the fix and flippers, what'll happen is they'll go to private money, they'll go to hard money, they'll borrow the money, and when the deal is done, they'll settle up and they'll take some percentage. Each guy will take some percentage of the deal. And basically, if you're good at what you do, you're going to make a bunch of money on the back end. And that's paid for being smart, for identifying a really good deal, for seeing the thing go up in value, for executing it properly. That's being smart. That's being good at what you do. The problem with that is that there might be 3, 4, 6 months, whatever it is, that it takes to get to that place. And you're not being paid anything during that period of time. So when that happens, all the money that you made during the for being smart, a lot of that money is going to go to reimburse you for what it cost you to live during the first 6 months that it took you to put the deal together. So what that means is you really can't do a lot of deals when you're doing it this way. You can't do 3, 4, 5, 6, 10, 20, 30 deals at a time. You can't build tracks that take 2 years because most people don't have the financial wherewithal to make that happen. So the way the syndication business, the way Wall Street does it, is they get paid for both.
Welcome to the Wealth Through Real Estate Investing podcast, your source for real-world strategies focused on creating long-term wealth, cash flow, and financial freedom through real estate. Through guidance, tips, and stories of highly successful real estate investors and thought leaders, we provide you the tools to succeed and reach the lifestyle you always wanted. And now your host, Dwaine Clarke.
Hello and welcome to the Wealth Through Real Estate Investing podcast. This is your host, Dwaine Clarke, and today we have Joel Block. Joel began his career as a CPA with this prestigious firm of Price Waterhouse. During his time with the company's Entrepreneurial Services Group, Joel immersed himself in the real estate syndication business. After reviewing hundreds of partnership agreements and preparing many tax returns, he left the company in '86 to start his own syndication firm. After raising millions of dollars in short of 3 years, by 1990, Joel has built a property management firm with more than 40 employees with a portfolio in excess of $100 million. He continues to educate and syndicate real estate deals and other assets and counseling other educator and investors to getting into the business. Joel, thank you so much and welcome to the show.
Hey, well, listen, thanks. That's kind of a long intro. It's
yeah, no.
Today's not my first day on the job.
I really appreciate. I had mentioned pre-show that I've been following you for a long time. You were one of the first kind of syndicator educators. You know, the one that was doing it, but had a lot of education of value, and I was kind of following along, kind of when I started raw into the business, and so I really appreciate it. It's quite an honor to have you on. So. I hope I didn't chop up the intro too much, but I wanted to kind of give the audience a little bit of context of what they're going to be hearing today.
No, listen, it's fine. I probably should shorten it up a little bit. So.
Awesome. But for the stuff that we kind of missed out, can you kind of talk us about maybe what your current focus is on and, kind of detail about what the syndication is?
Well, listen, I started in the CPA business. I wasn't there very long. And then I went into the real estate syndication business. I did that for several years. As the economy started to change, I fell into a venture capital transaction. But once you learn how to raise money, whether it's for real estate or anything else, you can raise money for anything.
Exactly.
So I fell into a venture capital transaction and raised $10 million for a deal that I ended up growing all over the country and selling eventually to a Fortune 500 company. So that worked out pretty good. And then I just bought and sold other companies for the next many years. And in about 2012, I set up another fund, and as real estate was really starting to, it was very depressed. So we set up an opportunity fund to take advantage of those opportunities that we saw. So, that's what I've been doing for that. That kind of summarizes things, and and we teach other, guys that put together deals, either build homes or do other kinds of deals, fix and flip or build student housing or whatever they do. We teach them how to raise the money the same way that Wall Street does.
Mm-hmm. Yeah, the thing I had mentioned, part of like what you're saying will be is get paid for your time and for being smart. It was kind of something that kind of stuck with me. And it's kind of like with the syndication where not only you're able to build wealth for yourself and investors, but you're getting paid along the way. Can you talk about kind of how you structure and how do you teach others as far as kind of syndication?
Yeah, well, let's talk first about what the concept, because it's good you bring that up. I mean, you get
Mhm.
paid for two things: being smart and for your time. Most people are used to getting paid for being smart, or they're used to getting paid for the time. They're not used to getting paid for both. And so what happens is that most of the wholesale guys, the fix and flippers, what'll happen is they'll go to private money, they'll go to hard money, they'll borrow the money, and when the deal is done, they'll settle up and they'll take some percentage. Each guy will take some percentage of the deal. Um, and basically, if you're good at what you do, you're going to make a bunch of money on the back end. And that's paid for being smart, for identifying a really good deal, for seeing the thing go up in value, for executing it properly. That's being smart. That's being good at what you do. The problem with that is that there might be 3, 4, 6 months, whatever it is, that it takes to get to that place. And you're
Mhm.
not being paid anything during that period of time. So when that happens, all the money that you made during the for being smart, a lot of that money is going to go to reimburse you for what it cost you to live during the first 6 months that it took you to put the deal together. So what that means is you really can't do a lot of deals when you're doing it this way. You can't do 3, 4, 5, 6, 10, 20, 30 deals at a time. You can't build tracks that take 2 years because most people don't have the financial wherewithal to make that happen. So the way the syndication business, the way Wall Street does it, is they get paid for both. So what'll happen is they'll say, listen, the LLC, we're going to put all the money into an LLC. And basically what the whole concept is, it's really about taking an asset, an apartment building, a home, attractive homes, whatever you're doing. The concept is really to slice that asset up like a loaf of bread.
Mhm.
And you'll say to the investor, okay, it's sliced up like a loaf of bread. How many slices do you want? Each slice is 25,000, 50,000, 100, whatever your number is. I'll take 4 slices. I'll take 3 slices. I'll take 6 slices. Each person, that's what Wall Street is great at. And
Mhm.
the way most people do it, they really only have the ability to put one investor into one deal. And when you put 2 people into a deal, you really have to do it in a more sophisticated way. And that's the place that most people get kind of hung up, is what is the better way to do it. So the bottom line is you got to put them into a syndication or some kind of another structure. And there aren't very many ways that the government allows, uh, guys like us to take money from investors. In fact, the government doesn't really like it at all. I mean, they don't like the fact that people take risk. And
Mhm.
the 97% of citizens, they would really prefer them not to be involved in anything. Those are the non-accredited, those 97%. The 3% they don't care about so much. Those people have the wherewithal to earn more money, call an attorney, get help from accountants, and do their evaluation. But a lot of other people, they just don't have the ability, if they lose their money, to earn it back, and then the government has to take care of them. So that's why they're
Mhm.
they're very concerned about them. So long and short, it's really about slicing up an asset, and then as far as how we get paid, we are going to get a cut on the back end. But if the deal, because we're putting it in an LLC and we're selling shares, the LLC needs to hire a real estate broker.
Mhm.
Well, if you're a real estate broker, who do you think you'd like to hire?
Yourself.
Yourself, of
Yep.
course. And if you have the ability to run a property management firm, or be the mortgage broker, or
Mhm.
own a repair and maintenance company, and all the many different things. Let's say you have a GC license and you want to do some GC work. You can engage yourself as the broker of record, GC of record, the person that is doing all the services, and get paid along the way. The concept is, and the investors don't mind this under two circumstances. One is that they don't mind it because you got to pay somebody. There's got to be some real estate broker, might as well
Right.
be you, because you're not taking a salary, so they don't really mind that you're taking something. The second thing is, uh, this is perfectly legal and it's fair as long as you disclose it to the investors in advance. That's
Mhm.
why you have to have an attorney assist you. Um, we're one of the largest builders of syndications and funds in the country. We advise people on how these things work. Uh, we've been involved in hundreds and hundreds of these transactions, and we just understand whether it's a hard money fund or a real estate fund or a film fund or a venture fund, whatever it is, we understand this very, very well. And I just would tell people that if they're thinking about putting such a structure together, that they should really learn how the structure works, and then they should, jump into it. This isn't the kind of thing you call the attorney and you just say, "Hey, by the way, would you please set up a fund for me and mail me the docs when they're done?" Because
Mhm.
it's much more complicated. There are hundreds of choices that you have to make.
Mm,
because you're stuck with these documents for years and you want to make sure
right.
you get it just exactly the way you want it.
As far as kind of like, because we understand that you have to have a a broker or a property manager or a construction manager and stuff like that. For for investors that are looking at this and they're not quite understanding it, it's really about the educational part of it to kind of let them know, like, these are the components and this stuff has to be done. How much do you kind of put in as far as kind of educating new potential investors or other investors that come in, so they're fully aware of what's going on, so they feel comfortable in that
Well,
investment?
let me put it like this. So the word investor is a little bit confusing. So I really think about it. There are active investors, which is the deal promoter or the sponsor.
Right, right.
Then there are the passive investors, which are those are the pure investors. Those are the limited partners. So let's call them actives and passives, or limiteds and promoters, or you can call it whatever you want. But the word investor is a little confusing because it means many different things to different people. So in my experience, one of the things that I do in my business is I educate active people about how to set up these structures and how to be successful. Now, if I was counseling an active person, I would say that you need to spend a lot of time educating passive investors about
Hmm.
what's going on, or even better, if they've been experienced, they've already done this before. Let's say they've invested 3, 4 times in these different kinds of deals. Uh, see, a lot of people think that wealthy people are these accrediteds, and accredited means it's a standard set by the government, and accredited means that you make a couple $100,000 a year, 200,000 single, 300,000 married, or you have a net worth of $1 million or more, uh, not including your personal residence. So let's say that you have this $1 million of net worth, or let's say you make this money. Uh, you know, I would make sure that the people have some experience in these kinds of deals. They need to understand not so much all the stuff that the attorney puts in the documents, because that's sort of self-explanatory. But what
Hmm.
they need to understand is, that the money's not liquid. Please don't call me and ask to get the money back in 6 months. Make sure that this is long-term money. Make
Hmm.
sure that this is money that if something goes wrong, it's not going to injure your family,
Hmm.
and that you're not putting too many eggs in one basket. I mean, there are things that you have to make sure that investors understand. I mean, that's an obligation that we sort of have. If we don't do a good job with that, we're going to get a phone call from those investors someday, and they're going to say, "Listen, if I had understood this, I probably wouldn't have done it."
Hmm.
So we got to reorganize, or I need help, or there's some problem, and those are things that are really avoidable with
Hmm.
good communication. Now
Hmm.
attorneys would call them disclaimers. I just call it good communication. That
Exactly.
we just have to talk to the investors and make sure, hey, listen, is this right for you? It's not right for everyone, and you got to make sure it's right for the investors. And if you do a good job with that, then the investors are really going to they can be successful, and so can you.
Mm. Can you kind of talk about like the fundraising platform in general, as far as like how things was different when you started, syndicating deals, to now where you have the Jobs Act, where they kind of change things to make it a little bit more looser, to give more opportunities to on non-accredited investors, and just kind of change around. You have like the crowdfunding platforms and different things like that. Can you talk about the transition, how it was, and how are you, what was you able to do during that time period?
Yeah. You know, uh, the whole crowdfunding movement didn't exactly pan out the way everybody thought. Everybody thought it would like change everything, and it didn't exactly change everything. It has made some things better.
Hmm.
For example, if you are an accredited investor, you are eligible to buy into these deals that promoters advertise. Since when I got started, the only way that you could really connect with a promoter was, mano y mano, where, belly to belly. You'd have to kind of meet the person, you have to get to
Exactly.
know them. You get a referral, but you couldn't advertise. Advertising was strictly prohibited. Uh, and that's why it was kind of a country club business. Rich
Mhm.
people would kind of hang out together, and then they would introduce their friends. It was kind of a very elite and exclusive club,
Mhm.
which wasn't fair to a lot of people. And I'm not talking about the non-accredited. I'm just talking about even the accredited. So it was
Mhm.
really kind of an elite kind of a program. Uh, as the Jobs Act came in, and part of the reason it came in is because people kind of started to understand that they were being excluded from these deals. I mean, they were it was not fair. They were, and so the government looks at it in two different ways. One is they look at the non-accredited, and they look at the accredited. On the one hand, it's very difficult for the promoters to find the passive investors, and it's hard for the passive investors to find a variety of these active promoters, right? So what they said is, listen, if you're an active investor that is accredited, that has a good net worth and meet the requirements, then you can buy these things that these other guys can advertise, and that's kind of worked out very nicely. So a lot of guys are advertising. That's fine. You buyer beware. You got to be very careful. On the lower end, for the non-accredited, they also created some rules that said you can get involved in some deals too. And kind of here's what happened. Investors didn't really understand, the non-accrediteds, that they were not allowed to participate by the government's rules. It's not that so much that I don't want them to come in, although I recommend to my own guys, to the guys that we counsel, that they generally work with accrediteds because they generally have more experience, they have more money. It's kind of better. They're a little bit further along in their development. It's not that we don't want to work with them, but the government really has restricted the way that we can work with them. And so people didn't really understand this until Facebook went public. And I don't know if you remember this deal, but in the I don't know, 2010, 11, 12, it was very clear and obvious that Facebook was going to be going public. And a lot of the employees who had gotten employee shares were starting to kind of get itchy. They really wanted to get out of their shares. They had millions and millions of dollars. They wanted to go buy a house or start a family or whatever they wanted to do. And so they started selling their shares to third parties. So these buying groups started forming. And these buying groups, a lot of times they would say, you can't come in our group unless you have a certain net worth. And so all these people who wanted to be in the Facebook deal, because they knew it was going to be a great deal, were excluded, because they're going like, what do you mean you got to be accredited? What do you mean you got to meet these requirements? What do you mean I can't do it? And all of us, and these non-accredited people were yelling and screaming, are you telling me that you have to be a millionaire to make any money in the United States of America? I mean, that really blocks a lot of people out of the opportunity of making any money, which is really an unfair situation to all kinds of hardworking middle class people that really want to get to the next level, and they're excluded from it. So bottom line is, that's part of the Jobs Act too, is they said, you know what, let's open it up to all kinds of people. Let's just put some caps that you can only invest a little bit of money. So you can have some exposure to these deals. You just can't put a lot, because if it doesn't go your way, we don't want you going broke. This isn't Las Vegas. This is, although you can go to Las Vegas and gamble all you want. There's no restriction on that, just by the way.
Yeah, they'll let you do that.
They'll let you do that. They just won't let you put your money into an organized investment.
So can you talk about on the active side, again, and then we'll kind of jump on the passive side as far as kind of like, the pitfalls and stuff for, people to look out for, and maybe about like strategic partnering. Cause I talk with a lot of syndicators across the country that, multifamily, self-storage, and they kind of partner up to buy deals, and then they, raise capital together. Is that stuff that you help people as far as kind of structuring and, or, giving counseling and how to do that? And what's some of the best practices?
Yeah. So let's put it like this. When you have two legitimate companies that work together and they do a joint venture, those are really good. That's a really good idea. It's very common that companies will come together. It's not a partnership, because partnership kind of implies doing all kinds of things together. The joint venture is like a one-time, we're going to do this project together as a team. Yeah. And it's not uncommon. Now, what that probably means is that you have one company, raises money. So it's got to have its own structure and its own investors. And then you have either a person or another company that, has its own resources. And it's probably going to be another syndication or fund that has its own resources. And this company puts in $1 million, that company puts in $1 million, and then they share the responsibilities. They work on it together, however they decide to do it. Very common. That's not a difficult thing to put together. The individual structures are the more complicated thing to put together. But when the two companies decide they want to work together, that's just two companies making an agreement to work together. Not a big deal. What concerns me all the time, and different attorneys give different advice on this, but I'm not an attorney, but I really get squeamish about this. When you, let's say that you and your investor say, okay, let's tell you what, let's be joint venture partners, and we'll do a deal. So you put in the money, and I have the deal that I found, and I'm going to run the deal, and you're going to sit in your living room, and when we're done, I'll send you the money, and I'll give you your money back plus the profit, all the stuff, and we'll be good. And that's fine. That's a lot of people call that a joint venture. I would actually call that a syndication, even though it's only got one person. And I'll tell you, here's the thing about it. That's fine to do that as long as everything goes great. And by the way, in our society, you don't need life insurance if you're not going to die. You don't need attorneys if you're not going to get in a lawsuit, right? So, and you don't need other kinds of insurance if things ever going to go wrong. So, as we only need these things if something's going to go wrong. So if everything goes great, those joint ventures between a passive and an active are terrific. I wouldn't do it. But when something goes wrong, here's what happens. All the money gets lost, something goes wrong. The passive person is sitting in their living room going, what happened? Well, it didn't work out. Sorry. Well, thanks a lot. I'm sitting here in my living room and you lost all my money. So they call their attorney and they say, hey, listen, I invested in this deal and the guy lost all the money. Anything we can do? Well, yeah. What kind of deal was it? Well, we are joint venture partners. Oh, joint venture partners. Well, did you vote on anything? No. Did you have meetings? No. Did you ever walk the property and help do any of the work? No. Well, it doesn't really sound like you were a joint venture partner. It sounds like you were a passive partner. And if you're a passive partner, then you didn't do a joint venture. You bought a security, and the security gives you certain rights. And one of the rights is called rescission. And rescission just means just give me my money back and let's be friends. Okay. So although you're probably not going to be friends. So, so what happens is that you call the guy, the active guy, and you say, listen, talk to my attorney. And it turns out we really didn't have a joint venture, even though that's what we said we had. He said it really wasn't. And that was a mistake for us to write down that way. So he says it's really a security, and we didn't have security documents like a private placement. So you didn't make all the disclosures. And because you didn't make the disclosures, I didn't know about all the risks. If I'd have known all the risks, I would never have done this. So here's what we're going to do. I just want to rescind. So just give me my money back. And you're going like, well, the money's gone. I don't have it anymore. And well, that's okay. Just sell your house and give me the money. And that's how serious it is. I mean, you get into a lawsuit and they can really force you to do some things you don't want to do.
Wow.
So you really want to be careful if you're going to be doing these kinds of deals where you're taking money. Now, when the investor gives you the money and you securitize it as a mortgage, that's fine. That's different. That's not a security. That's a mortgage. But when you have an unsecured deal and there's an active and a passive, and the passive is reliant on the active, that's a security. And when you have a security, you've got these special rules that you got to follow. And that's what we do in the syndication business is we follow these special rules to be sure that we're safe and that the investors know what they need to know and everything is very well spelled out. So when you write a private placement, it really is for the protection of the promoter to fully advise the passives that they're getting everything what they understand. It creates great clarity. But if you don't do it, the promoter is really at risk. And it's not required, by the way. If you're dealing with accredited, it's not necessarily required to have these documents written, but it's sure a good idea.
Yeah, and like I said, that's great tips for the passive to to know what to the acts or look for and stuff like that. Is any other tips you can advise on the passive side as far as maybe making sure they're getting into a good deal as far as kind of like the safeties and stuff? I know everything.
Listen, one of the things that I do is I attorneys in courts of law will call on me because I'm an expert in this area. They'll call on me for my opinion when things go wrong in some of their cases. And, I always, talk about things like due diligence. You have to make sure, is the promoter that you're dealing with, is it a good guy? Is it somebody that, is not a bad actor? They haven't had any legal problems. They haven't had any bankruptcies. They haven't had any, they don't really have big problems to deal with. Having had a bankruptcy or a bad credit is not necessarily a bad thing. But you want to make sure they don't have securities violations, that they're really not somebody who's criminal or breaking the law or doing some things they shouldn't be doing. And you also want to make sure that they've got experience in the area that they're telling you they have experience in. You want to know what some of their other projects in the past are. You want to understand what their fee structures are. You want to understand what they're taking out of the deal. You want to know what you're going to get in the deal. How it really works. A lot of people really don't understand how these things work. You want to make sure you understand how long your money is going to be locked up. And if you can get out of the deal, maybe you can't. I mean, probably you can't, But if you need to get out of the deal, what are your options? And you need to understand these things. And I would tell people that they should not be involved in these kinds of complex activities if they don't understand what they're doing, because this is not a game for children. This is serious. I mean, I will tell you this. A lot of people ask me, Joel, do people really understand how this works? And I'll tell you that wealthy people very, very well understand how this works. CPAs, and I'm a CPA presently, and of course not an attorney, but CPAs in their training learn how this works. They learn how the taxes work when they're very young. Attorneys, when they're going through law school, they understand. They study the securities process. They understand how it works. The IRS, they don't like it, but the Supreme Court has ruled that it's legitimate, and they have to. This is the rules they have to have. So everybody in our society understands the way Wall Street organizes these deals. And they understand how the syndicators, the fund managers, guys like me, organize these deals, because we all do it using some rules. So number one, promoters, you can't make this stuff up by yourself. There's an industry standard, and you have to do the standard. And I would tell you that you don't want to joke around. You don't want to work with clowns. You want to work with people that are going to give you really solid advice. Second thing is, for promoters, we'll get back to the passives in a few minutes. One of the mistakes that promoters make is they rely too much on their attorneys. Attorneys advocate for them, which is really important. It's really great that they do that. But the truth is, you got to advocate for the deal. Right. There's a certain balance. You probably know as a real estate broker that there's one side, there's the other side, then there's the deal, and somebody has to put the deal together. If you don't put a deal together that's reasonable and fair, the investors are never going to say yes, and the promoter's not going to close any business. So sometimes attorneys get a little carried away in their advocacy, and they make the mistake of not kind of creating some balance. And that's why it's important to have some business sense in the middle of your transaction. And that's what we help people to consider, is what the business rules are. Attorneys give good legal advice. We don't do that. We give them business advice. How do you price your shares? How do you set up your voting? How do you, do the transferabilities? I mean, how do all the business issues that people want? How do you make your deal investor friendly? How do you get people to say yes? All those issues. There are really a lot of business issues in this deal that need to be addressed so that you can be successful. As for the passives, they just need to understand what they're doing so that they don't, put their foot in the mud and be sorry that they did it. Because these can be great. And I started to say, do people understand them? They understand them so well that the private placement business, the whole private securities industry, that what we're talking about, is bigger than the entire United States stock market.
Wow.
And think about why it's bigger. What asset do you think is held in private placement in all these little LLCs? What asset's held that way? Want to take a guess?
Oh, you mean the LLCs?
Yeah. What asset is held by the LLCs that makes it bigger than the whole stock market?
Oh, capital, real estate, and all.
It's all the real estate in the country. Right. Most of the investment real estate is held this way.
Exactly.
So investors thoroughly understand how these deals work, and they like it. It's the way that people put capital together. It's called capital formation. It's the way we put capital together. And in our society, many people put capital in a pool so that, because more capital can buy more stuff. One person can't really buy it. Listen, Bill Gates doesn't have all the money to buy everything he wants either. There's Warren Buffett and these other guys, they have a lot of money, but they don't have all the money in the world. But when we all put it together, we have a lot.
Exactly. Well, so we covered the active and the passive side. I wanted to kind of get some tips or stuff that you've seen that clients in the past in regarding to networking and finding capital. I know there's many different ways, but I know you have to follow the rules. But as far as kind of getting the word out that, there's potential opportunities, maybe just like sending out, information on the Houston real estate market, and people get interested and they can get introduced to you that way. Can you give us some tips there?
I mean, listen, the bottom line is that there's a lot of ways that actives and passives can connect together. First of all, they need each other. They're all part of the same investment ecosystem. So they all need each other. And we have to work together to make things happen. That's the first thing. Secondly, I tell active investors that passive investors are like yellow cars. You don't see them very often, but if you start looking for them, you'll see them every day. So where are these people? Where are these investors? Where they are? They're everywhere. They're in bars, they're in elevators, they're in escalators, they're in airports. I mean, they're everywhere. You just got to talk to people.
Mm.
and you got to tell them what you do. Now, I wouldn't shove it down their throat. You don't want to be associated with any kind of a negative, overselling that kind of person. But hey, listen, I run a fund and we raise money to buy real estate, share the profits with our investors. And then people are either going to say that they're interested, or they're going to walk away from you, or change the subject, or whatever. Somebody's going to say, "Hey, listen, that sounds interesting. How do I get involved in that?"
Hmm.
And long and short is that's when you talk to them. That's when you tell them, what you do, and maybe they're interested, maybe they're not. And that's at our symposium we help people. We help the active guys to kind of learn how that works and how to move it to the next level. But that's where it starts. It starts just by letting people know what you do. Maybe you're going to want to let them know about your market, but you have to let them know that you aggregate funds and you buy things. What you have to be careful of is you can't say we're raising $25,000 a share for XYZ property.
Right.
That's what you don't want to do. But hey, listen, to have a general conversation that says this is the nature of what we do. Attorneys have always told me that that's perfectly okay, and because you're not talking about anything specific, you're not talking about a deal. So, I mean, everybody's got to get their own legal advice. They got to follow their own attorney, but that's kind of the guideline that we use. If it's generic, we talk about it. If it's specific, we don't.
Awesome. Yeah, you had mentioned the symposium that you host. That's another one that you said is coming up. Can you kind of tell us a little bit more of the details as far as what you guys are teaching and helping active
Yeah.
investors?
About 10 years ago, I got a call from an executive at Marks and Millichap who asked me to come out and do a conference for them. And it's turned into this very nice program. And we've probably put through 1,000 people through the program, very high level guys that,
Wow.
that have people that have done, a fair number of deals, 5, 6, 7 deals minimum that really can do a good job. Because one of the things that the passive investors need to know is they need to know that the active people are not practicing with their money. That's just the one thing you don't want to do. And one of the things that I will frequently say is that there's a reason that doctors practice on cadavers. It's these low value targets that if you make a mistake, not a big deal. You don't want to practice with real people and real people's money. You have to get your experience somewhere, and after you've got that experience, then you bring it to the investor community and you start doing your own deals. So people have to meet a criteria to come to our program, and then we teach them soup to nuts how this works. We teach them how the legal side works. We teach them how the operating agreement works. We teach them how to talk to investors, how to work with investors, how to identify investors, kind of what the ideal avatar of an investor is. We just kind of go through, all the hoops of making that happen. It's an outstanding program that, some people will come out of it and say, wow, this is for me. This is exactly what I want to do. And I want to build a structure, and they'll go into the business. We've had a lot of guys be very, very successful. There are other people that say, wow, this is a little too complicated. I think I'm going to keep doing it how I did, but I'm really glad I learned what this is. So, different people will come out in different ways, and it's, listen, this is a great, great business. You just have to do it the right way. You have to make it work. And if you do that, it could really be awesome for you.
Also, and then do you have any dates coming up?
Yeah, the next one will be in Las Vegas in April 2020.
Oh, beautiful. We'll make sure to have that on the show notes for the future participants there. I had read part of the book, Stop Hustling Gigs and Start Building a Business. Can you kind of talk about what you learn in there or what people can expect?
Yeah, well, listen, I was in the venture capital business for probably close to 18 years, and launching businesses, starting, buying, selling, doing different things. And, there are some companies that just get it right. They just do a really good job. There are other companies, not so much. And so over my years, I cataloged all these different things that the better companies do and the not so companies don't do. And, my idea was that, as my children got a little older, that I wanted to teach my children some of these great tricks. And when I put the book together, I just looked at it and I thought, God, this is way too good not to share with other people. So, it's how money works and how revenue streams get built and how you negotiate good contracts. I mean, it's all these business secrets that I learned that entrepreneurial people could benefit from. So it's a remarkable book. People who read it, they love the style. It's simple. But if you mastered even one of these a week, if you read one, and there's over 100 tips in there, there's 101 strategies. I think there's actually a couple bonuses in there. But if you master even one a week or one a month, you'd be 10 times ahead of everybody you compete with.
Awesome. Cool. Can you kind of describe, I know you're doing coaching and consulting and, working on your syndication business. What's kind of a typical work day, and do you have any special morning routines?
Well, I'm not a highly structured person in that regard. So no, not really. I run a fund, and which we're winding down because it's reached the end of its useful life. So there's stuff to do there. We're selling properties, and we're negotiating with brokers and lawyers and other things like that. And I have the symposium that happens, twice a year, and I do a little teeny bit of expert work where I'll comment on some cases. So, I mean, that's the kind of stuff that I do, and I also speak to companies, and I do a couple of different things, always related to the same topics, the same financial concepts. One of the things that I noticed being in business for a long time is that Wall Street gives the best advice. I mean, the best advice and intel to these very valuable giant companies, but the same intel does not percolate down to the middle market. Those 50 million to $1 billion companies, or even maybe a little smaller, it just doesn't get down there. And so, part of, when I speak to audiences, I'm speaking to these middle market audiences, helping them to understand the inside track that Wall Street brings to the big guys, how to bring it to the little ones. And actually, there's a trend report. If people want the trend report, they can text the word trend to the number 72,000. And if they want to get in the flow of our syndication material, they can just text the word asset to the same number, 72,000. So if they do it twice, they can get all our stuff. I would tell your real estate people to get into the flow of our symposium material, because we produce these little videos, as you already referenced. We really teach people how this business works. We just, once or twice a week, we put out a video. We answer questions people write in. How does this work? How does that happen? And we answer the questions. So I would tell people, so either text asset to 72,000 or trend to 72,000, and we'll send you out the material. We'll set you up.
Great. Yeah, we'll make sure to add that in the show notes and send it out to our newsletter. I always ask all my guests, what are you most grateful for?
I have great kids, or a great wife. I have a great life. I mean, the entrepreneur business has been very good to me, and I just appreciate it very much.
Absolutely. I know you gave out some of the text information, but is there any other contact information that we can reach you at?
They can either reach me at bullseyecap.com or joelblock.com. Okay,
beautiful. Like I said, again, Joel, it's a pleasure to speak with you. Honor again. Like I said, we've been following you for years and learned a lot from you. And like I said, you just, so much stuff. You break down the business very simply, through your teachings and stuff like that. And hopefully this podcast can reach more listeners so they can be able to kind of share in that information, and everyone can grow together.
Well, listen, this is a great business. It's a great way for passive people to make money. It's a wonderful business for active people to run, so that they can make money for themselves, take better care of their families. And by the way, the fix and flip business is about a $10 billion business in the United States, which means that we make a lot of money. Contractors make a lot of money. Real estate brokers make a lot of money. Tenants have a place to live. I mean, families have new houses they can buy. Banks sell loans. I mean, it's a very big business. I mean, we are very big contributors to the overall economy. And so you can't forget really how important entrepreneurs are.
Exactly.
It's very significant.
Good message and good way to end that there. So again, I really appreciate you, and look forward to connecting again soon.
Hey, well, listen, thank you, and likewise.
All right, take care.
Thanks for joining us on this episode of the Wealth Through Real Estate Investing podcast. Don't forget to subscribe and leave us a review on iTunes or the listening platform of your choice. Also, please check us out at DwaineLClarke.com, as well as find us on Facebook for more useful content and resources.